New one-family home sales plunging over 17% in October. That's the biggest month-over-month drop since 2013. Meantime, the home builders ETF is up just over 3% since the election as investors weigh a Fed that's cutting rates versus a new administration that's threatened wide-ranging tariffs on key building materials. Joining us now is Sheryl Palmer. She's chairman and CEO of Taylor Morrison, one of the nation's largest home builders. Great to have you, Sheryl. So how much are suppliers looking to push inventory into the U.S. ahead of late January? How much of an impact would these tariffs be, you think, on your business, your industry, if they go into effect?
Well, thanks for having me here today. It's a great question. I'd start with it's probably a little too early to fully understand the real impacts. But having said that, we have for some time intentionally been developing a more resilient supply chain over really the past several years, continuing expanding the work, the practices that were necessary during COVID, not necessarily to prepare for any one specific event, but to keep us prepared and flexible for any potential impacts. And we've done this a number of different ways through SKU rationalization, shifting much of our product to domestically produced products, strengthening the relationships. I believe that, we will see some impact on cost, probably not on availability. The threat of tariffs in Canada and Mexico may provide a bargaining tool to allow for some renegotiation to strengthen the replacement for NAFTA. So we'll see if that's helpful. Those tariffs are already in place in China, as you know, so this will be an additional 10% burden. Many of our manufacturing partners, I think, have already shifted to countries other than China to avoid the current tariffs, so I don't think they'll be quite as affected. We'll probably see some margin grab from some.
Okay.
When I think about China, it's probably more electronics. When I think about Canada, the primary concern, I think, will be energy and lumber.
Makes sense.
Right?
I want to also ask you about your business specifically and the buyers in your business. Tell me about, in 2025, maybe beyond that, the importance of the move-up buyer, continued importance to margins, because they're less likely than those first-time buyers to try to get those incentive dollars into buying down the mortgage, which is more expensive than some other incentives. How important is it to get that move-up buyer, and are they moving up with rates staying this high?
Oh, yes. I mean, it's such an important question. I appreciate it, John, because the diversity of our portfolio, I think, is one of the keys to the success that we've had for quite some time. And you're right. The move-up buyer is about a third of our business. Our resort lifestyle, some refer to it as the 55 plus, is another third of our business. And they're in a very different position. I mean, those consumers on average in the country today have over $400,000 in equity. And when you look at the impacts of what we've seen over, I'd say the last 3 years, probably since 2020, so maybe 4 years, we've seen 17% rise in income. We've seen 30% rise in actual home prices, but we've seen a 75% rise in payments. And that is disproportionately impacting that first-time consumer. When you think about our move-up buyers, our resort lifestyle buyers, nearly 40% of the homes today don't have a mortgage, and that's generally the move-up buyer. So they're a critical part of our business. And when we look at the average age, the other stat that I found quite interesting, when we look at the average age of buyers, really over the last 30, 40 years, the average age has moved up about 8 or 9 years. Once again, really speaking to the strength of that move-up buyer.